What's up, future investors? Have you ever wondered why Bitcoin prices go up and down like a crazy roller coaster? Well, today we're going to uncover the secret connection between the big economy around us and cryptocurrency investing. And trust me, once you understand this, you'll basically have superpowers when it comes to understanding money. By the end of this video, you'll know exactly why your older brother's crypto portfolio crashed during COVID, why people buy more Bitcoin when they get raises, and how the stock market and crypto dance together like they're best friends. Let's dive in! Before we jump into the cool connections, let's quickly review what we're talking about. Cryptocurrency, or crypto for short, is basically digital money that lives on computers instead of your piggy bank. Think of Bitcoin like the superhero of digital money. It's the most famous and the one everyone talks about. Now the economy is like a giant game that everyone in the world plays together. It has three main parts. People making stuff, like your favorite video games and pizza. People buying stuff when your family goes shopping. People selling stuff, the store owners who sell to you. When lots of people have jobs and money flows around easily, we call that a good economy. When people lose jobs and struggle to buy things, that's a bad economy. Think of it like your school cafeteria. When everyone has lunch money and is trading snacks happily, that's a good economy. But if half the kids forgot their lunch money, not much trading happens. So here's where it gets really interesting. When the economy is doing awesome, there's a super predictable chain reaction that happens. Let me show you our chart from earlier research. Here's the magic formula. More jobs available. Your parents and other adults are working and earning good money. Higher disposable income. After paying for important stuff like food and housing, families have extra money. Increased risk appetite. People feel confident and want to invest their extra money. More crypto investment, too. Some of that extra money goes into Bitcoin and other cryptocurrencies. Crypto prices rise. When lots of people want to buy, but there's limited supply, prices go up. It's like when a new limited edition gaming console comes out. If everyone wants it, but there aren't many available, the price shoots up. This is exactly what happened during 2020-2021 when Bitcoin went from around $10,000 to almost $70,000. That's like buying something for $10 and then selling it for $70. But what happens when the economy takes a nosedive? Well, it's like watching that same chain reaction happen in reverse, and it's not pretty. Here's what happens during tough economic times. Job losses. People lose their jobs or get their hours cut. Lower disposable income. Families have to be super careful with every dollar. Risk aversion. Instead of investing, people want to keep their money safe. Selling crypto assets. People sell their Bitcoin to get cash for essentials. Crypto prices fall. When everyone's selling but nobody's buying, prices crash. This is exactly what happened in March 2020 when COVID-19 hit. Look at this chart. Bitcoin fell from about $10,000 to under $4,000 in just a few weeks. People were so scared they sold everything, including their crypto, just to have cash for groceries and rent. Remember, when times get tough, people always prioritize buying food, medicine, and keeping their homes before they think about risky investments like crypto. It's like choosing to buy lunch before buying a new game. You need lunch more. Now here's something that might blow your mind. Bitcoin and the stock market often move together like they're doing a coordinated dance. This chart shows how closely Bitcoin and the S&P 500, that's a big collection of stocks, move together over different time periods. When the number is high, like 0.61, it means they move together a lot. When it's low, like 0.09, Bitcoin is basically dancing to its own beat. During scary times like the COVID pandemic, both Bitcoin and stocks fell together because people were worried and wanted to keep their money safe in banks instead of risky investments. The correlation hit 0.61. That's like them being attached by invisible strings. But during Bitcoin's big bull run in 2020, it moved more independently from stocks with a correlation of just 0.09. It was like Bitcoin put on its headphones and started dancing to its own music while stocks did their own thing. Just like we have different types of weather, the economy has different conditions that affect crypto in unique ways. Let me break down the main types. Goldilocks economy. perfect weather, sunny with a light breeze. This is when the economy is growing steadily, but not too fast. It's called Goldilocks because it's just right, not too hot, not too cold. This is amazing for crypto because people are confident and have money to invest, but they're not panicking about anything. High inflation. Super hot, sweltering day. This is when everything gets more expensive really quickly. Your $5 allowance suddenly buys less candy than it did last month. Sometimes this helps crypto because people think Bitcoin might protect their money from losing value, but it can also hurt if people get too worried about the economy. Deflation. Freezing, cold day. This is when prices actually go down. Sounds good, right? But it's usually bad for crypto because people prefer to keep their money as cash when they know prices will be even lower tomorrow. Reflation. Beautiful spring day after a harsh winter. This is when the economy starts growing again after tough times. It's usually great for crypto because people become optimistic and want to invest again. Let me tell you the wild story of what happened to crypto during COVID-19. It's like the ultimate real-world experiment that taught us everything about how the economy affects crypto. Phase 1. The crash, March 2020. When COVID hit, it was like someone yelled fire in a crowded theater. Bitcoin crashed from $10,000 to $3,800. That's a 62% drop. People were so scared they sold everything, including crypto, just to have cash for emergencies. During this time, Bitcoin's correlation with stocks hit 0.61, the highest it had ever been. It was like Bitcoin forgot it was supposed to be digital gold, and instead acted like just another risky investment. Phase 2, the recovery, 2020 to 2021. But here's where it gets interesting. Once people realized the world wasn't ending, something amazing happened. Big companies like Tesla and MicroStrategy started buying Bitcoin. People stuck at home with stimulus money started investing. The economy was weird. Some people lost jobs, but others had more money than ever. Bitcoin didn't just recover, it absolutely exploded, reaching almost $70,000 by 2021. Meanwhile, its correlation with stocks dropped back down as crypto did its own thing. Phase 3, the lessons. COVID taught us that during extreme crises, crypto acts like a risky asset, not a safe haven. But it also showed us that crypto can recover faster and stronger than traditional assets when conditions improve. So why should you care about all this economic stuff? Well, understanding how the economy affects crypto is like having a crystal ball that helps you see the future, predicting market trends. If you understand that good economies usually mean higher crypto prices, you can make smarter guesses about what might happen next. It's like knowing that dark clouds usually mean rain, understanding risk. Crypto is already pretty risky. Prices can swing wildly, but understanding the economy helps you know when it might be extra risky. Like knowing not to go swimming during a thunderstorm. Timing decisions. Smart investors, when you're older and have money to invest, use economic signals to help decide when to buy and when to sell. It's like knowing the best time to buy ice cream is right before summer, not right before winter. Diversification. This fancy word means don't put all your eggs in one basket. Understanding how crypto relates to the economy helps investors spread their money around different investments. Sometimes crypto goes up when stocks go down, and sometimes they move together. Building financial literacy. Learning about economics and crypto now gives you a huge head start on understanding money, investing, and how the world works. It's like learning the rules of a game before everyone else even knows they're playing. All right, future Warren Buffetts, let's wrap this up. Here are the key things to remember. The economy-crypto connection. When the economy is good, people have more money to invest in crypto. When it's bad, they sell crypto to get cash for essentials. The dance partners. Bitcoin and stocks often move together during scary times, but they can also move independently during normal times. Economic weather. Different economic conditions, inflation, deflation, growth, affect crypto in different ways. The COVID lesson. During extreme crises, crypto acts like a risky asset, not a safe haven, but it can recover spectacularly. Why it matters. Understanding these connections gives you superpowers for understanding money and investing. Remember, this is just educational content to help you understand how the world works. Crypto investing is very risky and should only be done by adults. who can afford to lose money. Never invest money you can't afford to lose. If you enjoyed learning about the secret connections between the economy and crypto, smash that like button and subscribe for more financial education content. Drop a comment below. Tell me what economic topic you want to learn about next. Until next time, keep learning and stay curious about money.